Okay, so we are looking at capital budgeting. So this capital budgeting is also called investment appraisal technique, where you need to appraise an investment if it is worthwhile for you to go ahead and invest in a project, or it will not be worthwhile for you to make an investment in the project. So as we look at the lesson scope, capital budgeting is made up of two words, capital and budgeting. In this context, we're talking about capital expenditure. You want to buy an equipment to use in business. Would that be worthwhile for you to invest in that equipment? Are you going to get your money back? So that's what it means when you're looking at appraising an investment, which is capital budgeting. So made up of two words, capital and budgeting. In this context, capital expenditure is the spending of funds for large expenditures. There. Okay. Yes. So capital expenditure is the spending of funds for large expenditures, like purchasing fixed assets and equipment, repairs to fixed assets or equipment, research and development, expansion, and the like. So first and foremost, we have to look at what is this capital budgeting. On the scope, so we look at what is capital budgeting, what are the objectives of capital budgeting, and also we look at the capital budgeting process. Then we look at the capital budgeting techniques, and then therefore we look at the last one. We're looking at the conclusion. So it is necessary after the end of this lesson for people, students, to understand this capital budgeting. It is also an evaluation of a project that you assess. Can you invest in transport business? Can you invest in real assets like in a building? Would it be worthwhile? Are you going to have any returns as a result of making an investment in that asset? Okay, so capital budgeting is a process of evaluating investments. So you are just evaluating an investment and the huge expenses in order to obtain the best returns on the investment. So this is what capital budgeting is all about. Then an organization is often faced with the challenges of selecting between two projects or investments, or the buy versus replace decision. Okay, so an organization should have this challenge of selecting between the investments as they are trying to appraise an investment. An organization would like to invest in all profitable projects, but due to the limitation of the availability of capital, an organization has to choose between the different projects or investments. Therefore, we look at the capital budgeting as a concept after that's a concept that affects our daily lives, because we are able to assess which investment are we going to look at. Okay, so that is what capital budgeting is all about. And there are, of course, there are 5 techniques. Yes, please. There's a question. Is that a question?
No, there is no question.
All right then. Okay. So You can be indifferent. In which project are you going to invest? Okay, so you will decide, can I invest in a building? Can I invest in transport building, in a transport business? Or in which project are you going to invest? Okay, so you look at all those techniques that we use to evaluate a project. An example, your mobile phone has stopped working now. You have two choices: either buy a new one or get the same mobile repaired. Okay, so is it worthwhile for you to maintain the same mobile phone, or can you get a new one? Would it be profitable if you are to maintain the same one? If you are using that mobile phone for your business, an example, or you are using your vehicle for business, will you get the new one, or you would still maintain the same vehicle that you have, that you are using for business? So you have to look at which one will give you the higher returns as you look at the considering the evaluation techniques that we use in capital budgeting. Of course, there are 5 techniques that we use. Okay, for those who are able to write somewhere on a piece of paper, the first one, we look at the net present value, okay, on those techniques. So here we're looking at the examples of a mobile phone. You can get a new one, or can maintain or just repair the same one that you can use and continue making returns. Now, let us look at the objectives of capital budgeting first of all. So capital budgeting expenditures are huge and have a long-term effect. So therefore, while performing a capital budgeting analysis, an organization must keep the following objectives in mind. Number one, selecting profitable projects. Okay, so a company or organization comes across various profitable projects frequently, but due to capital restrictions, an organization needs to select the right mix of profitable projects that will increase the shareholders' wealthy. So you have to look at the project, which project can you select that will maximize your wealth as a shareholder, the part of the company. That is about the first one. Then you look at also uh, the finding the right sources for funds. Of course, you also have to consider capital expenditure control. Okay, so that's number 2, capital expenditure control. First of all, the first objective is to select the profitable projects. That's the objective of capital budgeting. So a project that is going to give you a higher return, the project that will give you the positive net present value, those are profitable projects. The project that is also going to give us the higher profitability index, the project that also going to give us the accounting rate of return greater than the cost of capital, and of course the project that will also going to give us the internal rate of return greater than the cost of capital. That is on the actually on, as we looking at selecting profitable projects. Number 2, we're looking at capital expenditure control. So that's another objective of capital budgeting. So selecting the most profitable investment is the main objective of capital budgeting, of course. However, controlling capital costs is also an important objective. That is on number 2 aspect of objectives of capital budgeting. Then we get to the last one where we're looking at finding the right sources for funds. That's another objective. So determining the quantum of funds and sources for procuring them is another important objective of capital budgeting. This is, of course, finding the balance between the cost of borrowing and the returns on investment is an important goal of capital budgeting. Okay, so capital budgeting process, we are looking at identifying investment opportunities, capital budgeting process. So you have to look at in which investment are you going to, in which project are you going to invest? That's identifying investment opportunities. Can you invest in transport business? Can you invest in real assets, in the building? Or in which investment are you going to consider? Which investment are you going to consider? So that's the first one. You identify, and then after identifying, you choose the most profitable investment. Okay, you can choose the most profitable investment. That's another process that you need to consider there. Of course, you also need to evaluate your investment. As much as you identify, as you select which will be profitable, you have first of all also to evaluate the investment proposals. And of course, you have to go for capital budgeting and apportionment. Then you do a performance review to check if all is well. Then you can go ahead and invest in that given project. Is it clear so far before we get into an example, a real example of how we can get into evaluating a project? Okay, so let us getting into evaluation now. We can get into evaluation now, where we look at the example here, capital budgeting or investment approach technique. We have this question that we need to look at as an example. A company has purchased an office equipment for 120,000. This equipment is to be used in the business for 6 years, after which the residual value of the equipment will be 0. Now, this residual value is also called the scrap value. So meaning this equipment is used in the business for 6 years, and after which the equipment would have the value of 0. The expected profits or losses for each of the years is given below. Depreciation is calculated using straight line method. So you have the years 0 through to year 6. In year 0 simply means that this is when an investment, this is when the company has purchased this office equipment. And we talk about this figure being in negative because it's an outlay, it's an expenditure. This money the company is likely to lose. It's in brackets, it's negative because it has gone, it has been invested in business, it's no longer with us. So any negative figure means a cash outflow, but these are profits or losses. So these are profits or losses. Are we together so far? Are we together so far? Okay, so the required cost of capital for the project is at 10%. So the required cost of capital for the project is at 10%. Then we are required to calculate the following. The first one says calculate the payback period. The second one, the NPV, the internal net present value, that's the second one. Then the other one is profitability index. Then accounting rate of return and the internal rate of return. Am I too fast? Excuse me?
No, you're fine.
Okay, so are we able to check the question so far? the question to do with the company purchasing an equipment for 120,000 and those profits or losses. Have you seen the question so far? Okay, you've seen the question so far? Okay.
Yes.
Yeah, so now the required cost of capital for the project is at 10%. So this company invested 120,000 in this equipment, and at year zero, that is, because that's the time they made a purchase, and then the profits or losses thereafter that for year 1, year 2, year 3, year 4, year 5 through to year 6, we have those profits or losses. Required cost of capital, we have the 10%. So we all need to calculate now the payback period, the net present value, the profitability index, accounting rate of return, and the internal rate of return. So first and foremost, we are told that the depreciation charge, we are using the straight line method of depreciation. And this is the depreciation we're using. So if you get to the page, get with me to the page where we need to calculate the depreciation. Depreciation is equal to the cost minus the residual value over the number of years. So the depreciation is calculated by the cost of an asset minus the residual value of that asset, then you divide by the number of years. This is how you find the depreciation using the straight line method. So we have the cost of this asset is 120,000 minus the zero residual value at the end of the 6 years, then divide by 6, that's the number of years, we are getting the depreciation of 20,000. This simply means that for each year, the equipment is losing a 20,000 kwacha. There is a loss of value of 20,000 kwacha for the equipment. So if you can multiply the 20,000 kwacha by 6, you are getting the total of 120,000 kwacha, meaning that there will not be any value for that equipment. The equipment would have lost value completely at the end of 6 years. So in this case, we therefore need to add back depreciation to the profits or losses shown in the table in order to get our original cash flows as they came. As they come, you have to add back the depreciation so that we get the original cash flows. So for year zero, we are making an investment of 120,000. Then the cash flow for year 2 will be the 12,750 plus the 20,000 quarter depreciation. I know there can be an argument, why do we add back the depreciation? This is because the depreciation does not get the physical cash from this company or from this equipment. Same as when you purchased your vehicle some time back, then you purchased it at a certain amount, maybe 70,000, and today you have to just assume that it has depreciated by so much, but the physical cash from that equipment or from that vehicle hasn't been seen. There's no physical cash involved there. So meaning those profits or losses, that's the reason why we are adding back the depreciation to get the original cash flows as they come. So for year 1, our original cash flow will be the accounting profit of the 12,750. To each of those profits, we're supposed to add back the depreciation of the 20,000. So we are getting the original cash flows. The first one is 32,750, 58,700, 75,250, 12,750 for the 4th year. The 5th year is 18,250, and the 6th year is 42,000. So these are the cash flows that we have before carrying out anything, before computing that we are required to compute the payback period. We are also required to compute the net present value. We are also required to compute the profitability index, accounting rate of return, and the internal rate of return. Okay, so is it clear so far? Before we proceed to calculating the payback period? Is it clear so far? Hello? Is it clear so far?
Yes, it is.
Okay. So now, if you have a calculator with you there, you can check. We invested 120,000. Then year one, we recovered only 32,750. So we start adding. The first one, we have recovered the 32,750 for the first year. The second year, we have recovered 58,700, meaning for the 2 years, we would have recovered 91,450. But this amount is not enough because we need to recover exact amount of 120,000 kwacha. So how long will that take, or will it take for us to recover the exact amount of 120,000 kwacha? That's what it means by payback period. So the difference that we have here between the 2 years, for the 2 years, if you add the 2 years, we are getting the 91, the total for the 2 years, year one and year two, our recoveries for the 2 years, year one and two, we are recovering 91,450. So there is a shortage of, so we subtract 120,000 minus 91,450. We have a shortage or a shortfall of 28,550, which we can get from the third year, which we can get from year three, which we can get from the 75,250. So meaning we are going to say our payback for in the meantime, we're going to say our payback is 2 years, then plus the 28,550, which we need to recover from the 75,250. So we divide the 28,550, you divide by 75,250, then add the 2 years there. So we are getting our payback is 2.38 years. 2.38 years. Okay? Just confirm that. If you are okay with that one, before you proceed to the other one, let me know before you get to the other one. Because the first one says we need to find the payback period. Then the second one, we need to find the net present value. So for the first one, our payback period is 2.3 years. So is that clear so far?
Yes, it is.
Okay, that's fine. Let's move on. We move on to the NPV. NPV, we are going to use the same figures here that we have in this table. These are the ones we found, where we added back the depreciations. We are going to use these ones, but don't forget, we are going to use the cost of capital of the 10% that has been given there. So the 10%, which is given in the question, is what we are going to use for us to actually compute the net present value. So I have to make mention here that the net present value, profitability index, and the internal rate of return, these three, including the payback period, these four in short, the payback period, the net present value, the profitability index, and internal rate of return, these four, they use original cash flows as they come. Then the ARR, which is accounting rate of return, this one uses average accounting profit. This one uses average accounting profit. So this one, the accounting rate of return accounts for profit. It does not entertain the original cash flows as they come. So we just use the original profits as they are in the original question, not losing the adjusted one where we added back the depreciation. for only the accounting rate of return is what we're going to do. Okay, so we get to the NPV. NPV, we look at the cash flows, the discount factor. This is 10%, so we are using it's 1 plus R in brackets raised to the power negative n. So NPV, we say 1 plus R in brackets raised to the power negative n. That's how you find the discount factor. So for the first one, it's 1.1. 1.1 is because it's 1 plus R to the power negative n. So you will see R is 10%, which is the same as 0.1. 0.1 plus a 1, it will be 1.1. Now that one, we should be raising them to the power according to the year stated there. So the first one is a 0, so that's why it's still 1 there. Then multiplied by 120,000, so giving us a present value of negative 120,000. Okay, then we go to year 2, you multiply the 32,750 multiplied by 0.909. This one, you ask me how we are obtaining them. It's just because of using the 1.1 in brackets raised to the power of negative 1. If you have a calculator there, compute 1.1 close brackets raised to the power negative 1. It's giving us the 0.9090909, but you can go for 3 decimal places at least. So when we say at least the 3 decimal places, meaning that 3 is the least, but we can go for 4 decimal places, 5 decimal places, or all those decimal places, but even 3 is okay. So you have the 0.909 for the first year as a discount factor, then you multiply by the 32,750, you get the last figure there as a present value for that amount. Similarly, you will do the same for your year 2 through to year 6. Okay, so year 2, 0.826, that's a discount factor there. Multiplied by that, you're getting the present value, which is at the last column there. So there is the year column, cash flow column, the discount factor column, and the present value column. Okay, so after multiplying each of these figures with the cash flows, we have gotten these figures at the last of the end column there. Then add the positive figures that we have for each of those years, year 1 through to year 6. Add all of them, then subtract the 120,000. You are getting the 58,498.2. So we are adding only the positive aspect of these, where we are saying we add that where it says starting from the 29,769.75, then plus 48,486.2, 56,512.75, 8,708.25, 11,333.25, 23,688. All these positive ones, we add them and subtract the 120,000, then we are getting NPV of 58,498.2. So in this case, if the NPV is greater than 0, you accept the project. Otherwise, if less than 0, you reject the project. Is it okay so far up to the NPV? Is it okay so far up to the NPV? Okay. Is it okay so far up to the NPV? Or do you still need an explanation? Hello?
Yes. Yes.
It is? Okay, then. We get to the profitability index now. So profitability index, where simply means it's the sum of all present values over initial investment. The sum of all present values over initial investment. So what I mean here is that we start adding all present values from the 29,769.75 from all present values. So the sum of present values of all these present values, then you will divide by initial investment. So when we add from the 29,769.75 plus the 48,486.2 plus 56,512.75 plus 8,702.25 plus 11,333.25 plus 23,688. Then you divide by 120,000. So we divide by 120,000. So we are getting profitability index as 1.487485. So meaning that this one, an interpretation for this profitability index is that our initial investment has gotten into our recoveries 1.5 times. Okay? Are we together? So our profitability index is 1.4874, meaning that this profitability index, our total recoveries, our initial investment has gone into our total recoveries 1.48 times, 1.5 times in short. So meaning 1.5 times, what it means. So we are able to recover. So here we accept the project if the profitability index is greater than 1, otherwise reject the project. Then we have to get into what we call the accounting rate of return. So accounting rate of return, it is a return for shareholders. It's a return for shareholders. And because they need to maximize their wealth, well, shareholders want to maximize their wealth. So it is the shareholders ratio or shareholders evaluation technique. And in this case, we need to accept the project if account rate of return is greater than the cost of capital. So as we come here, we have to find the formula for account rate of return is equal to average accounting profit, then you divide by initial investment in the project. So average accounting profit, then divide by initial investment in the project, then multiply by 100%. So accept project if accounting rate of return is greater than the cost of capital, otherwise reject the project. Now, from this, we are given the profits. So average accounting profit, you get the profits as they are in the table, original table, the initial table. So the first table, the profits as they are, you find the average of these profits from year 1 through to year 6 and find the average of those, that's average accounting profit. So we have to add all those. So the 12,750 plus 38,700 plus 55,250 plus minus 7,250 plus minus 1,750 plus 22,000. So we are getting the 119,700. Then we divide by 6, we are getting 19,950. Okay, so that's average accounting profit. Then you divide by initial investment of 120,000 multiplied by 100. So we are getting 16.625%. So here you accept the project because account rate of return is greater than the cost of capital of 10%. So 16.625 is greater than 10%. So accept the project. Okay. So anyway, we get to the last technique now. But before anything else, if there are questions, please ask questions now. Before maybe we proceed to the other technique that is called the internal rate of return. Is there any question so far? Is there any question? Excuse me? Is there any question so far? Okay, so internal rate of return, we'll say the formula is equal to A1, which is the rate 1. A1 is rate 1 plus NPV1 over NPV1 minus NPV2, then multiplied by B2 minus A1. So B2 is rate 2, A1 is rate 1. So here we should set B2 in such a way that we get a negative NPV2. So the higher the rate, the smaller the NPV. That's the relationship between the interest rate and the net present value. The higher the interest rate, the smaller the NPV. So in this case, we need to find the NPV2 to be negative. So here we had set our our rate 2 at 60%. So set rate 2 at 60%. Okay, so rate 2 at 60%, we are saying your 120,000 cash flow. The discount factor is 1.6 to the 1.6 in bracket to the power negative 0 is 1, which is 120,000. Are we there? Hello? Are we there? Okay, so for you, are we there?
I just rejoined. I lost my internet.
Oh, okay. Okay, so where is it? Where is it that you're behind?
What we were talking about before this.
Okay, before this, we are talking about accounting rate of return. On profitability index, were you there on profitability?
Yes.
Profitability, okay, profitability index, okay, fine. On profitability index, I mentioned that
Yes.
if the PI is greater than 1, then you accept the project because your initial investment has gone into the recoveries, like in this case, 1.48 times, which means about approximately 1.5 times. So you've gotten your money, you know what I mean? So it's worthwhile if the PI is greater than 1. Otherwise, don't invest in the project if the PI is less than 1. Then in the other technique, we are talking about the accounting rate of return. This is actually the shareholders return because of wealth maximization, because this one accounts for profit. So the formula for this one is average accounting profit, then divided by initial investment in the project. That's the formula. Then multiply by 100%. So in this case, you only have to accept the project if the accounting rate of return is actually greater than the cost of capital. Otherwise, reject the project. So from the table, we were given the accounting profits. So we need to find the average of those profits as a numerator on the formula here. Average accounting profit over initial investment in the project, which we know the initial investment in the project is 120,000. So average accounting profit, we add all those 12,750 plus 38,700 plus 55,250 minus 7,250 minus 1,750, then plus 22,000. Then whatever amount we get, divide by 6. So we got 119,700 divided by 6, which is 19,950. Then our accounting rate of return is equal to 19,950 divided by 120,000 and multiplied by 100. So we are getting our accounting rate of return as 16.625%. And then here we need to accept project if the accounting rate of return is greater than the cost of capital of 10%. And for sure here we've seen the 16.625 is greater than 10%. So we accept the project and make sure we invest in this given project or equipment. Okay. Then yes, please, is there a question now? Is there a question?
No.
Okay, no, that's fine then. Okay, so we get into the other technique where we look at the internal rate of return. So internal rate of return, this return you've seen even from there is a return that investors expect as a result of making an investment in the project. And it depends on NPVs for it to be computed. So that is also can be a disadvantage of NPV because it cannot be computed on its own. It depends on the NPV for it to be computed. And it uses two rates, rate 1 and rate 2. So the formula there for internal rate of return is equal to L1. L1 is for rate 1, then plus NPV1 over NPV1 minus NPV2, then in brackets, B2 minus A1, B2 minus A1. So this is the internal rate of return formula. This is the internal rate of return formula. Now, we should set B2 in such a way that we get a negative NPV2. So what it means here is that the higher the rate, the smaller the NPV. So the smaller the rate, the higher the NPV. That's the relationship between the interest rate and the NPV. So in this case, we had used the original A1 was given in the question. The A1 was 10%. Then the B2 is rate 2, which we can set as large as possible to deviate from A1, so that we get the negative NPV2. Okay, so as we can see from there, you can see we have the year 0 through to 6, and then the cash flows. We have the cash flows there given. The discount factor in this case we are using a 60%. So the first one is 1.6 raised to the power negative 0, which is giving us 1. And then for year 2, 1.6 to the power negative 1, 0.625. Those are discount factors. Then multiplying them by the cash flows as they come, we are getting the present values. So if you've seen the present value from year 1, for year 1 is 20,468.75. Year 2 is 22,928.22. Then that of year 3 is 18,368.53. Year 4, 1945.65. Then adding up all these from year 1 through to year 6, subtracting the initial investment in the project, we invested in this equipment 120,000. So our NPV2 has given us 52,044.6. It's a negative 1. So from here now, we're able to calculate the internal rate of return, substituting this figure, NPV2, in the formula given above there. We are getting, so internal rate of return, the A1 is the original cost of capital given for the discount factor of 10%, which is 0.1 there, then plus the NPV1, which we computed was 58,498.2. You bring it down from according to the formula, so we bring it down, then minus, so the bottom part here, because this is minus, it will give us a plus. So these two, you are going to aggregate them, and we are getting the 110,542.8, because this one and this one was negative, so it gives us a positive 1. Then as you subtract the 0.6 minus the 0.1, we're getting the 0.5. So whatever we do here, the numerator for this one, 58,498.2 divided by 110,542.8. Whatever we get here, you multiply by 0.5, then plus the 0.1, then everything in brackets here, we multiply by 100%. Our internal rate of return, we're getting the 36.459%. So this clearly indicates that if the internal rate of return is greater than the cost of capital of 10%, then you accept the project, otherwise reject the project. I'm sure you are able to check the figure that we have actually obtained. Is it clear so far?
Yes.
It is. Okay, so if it is, then thanks very much for that. So you really need to go through, especially on these techniques. There are only 5 for capital budgeting as you are appraising an investment. Is it worthwhile for you to make an investment in any building or in an asset? Or which investment venture can you get in? Which one can you get in? Is it worthwhile for you to carry out an investment in a given project? So you have these 5 techniques. Sometimes on the theory aspect, they'll ask you in an exam to say, explain the techniques used in capital budgeting. So there are only 5, like I mentioned you have the payback period, you have the net present value. So payback period simply means how long are you going to recover the exact amount you invested in the project. Of course, the shorter the payback, the better. Okay, but of course, the payback period is not very good because you will find once you have gotten your money, then you will start ignoring about the other cash flows as they come because you just say, what more? I've already gotten my 20,000 which I invested in this building. So you stop accounting for the other monies as they come, which is a major disadvantage of the payback. And of course, you know, um, doesn't the payback period does not consider the time value of money. You don't account for the time value of money. So that's another disadvantage of a payback. But of course, there are 5 techniques I mentioned: payback period, the net present value. Uh, we have the profitability index, accounting rate of return, and the internal rate of return. Okay, so you just really need to go through um, this material. Is that clear?
Yes, it is.
Okay, then be ready for the other topic that will be coming later in the day, which is marginal and absorption costing. So expect marginal and absorption costing. Also expecting a topic on the CVP, which is on the cost volume profit, and the other one to do with the budgeting. There's another one to do with budgeting that we also need to also look at.
What time?
Um, I need to find out from Mr. Njovu, Mr. Collins, so that we see the time that that class will be there.
Okay.
All right, then you're welcome.
Okay, so we are done with the first